JP Morgan projects that gold will hit $6,000 an ounce by 2027. HSBC is forecasting a target of $5,000. Major financial institutions are setting pricing targets that appear to ignore decades of established financial theory. Usually, gold follows a specific economic rule. Because physical metal pays no yield or dividend, it loses its appeal when central banks raise interest rates to combat inflation. Capital typically moves to assets that offer a direct return. Currently, U.S. interest rates are sitting at long-term highs, and the U.S. dollar is exceptionally strong. Under those conditions, Western investors react according to the textbook. In Europe and the U.S., institutions are pulling capital out of gold ETFs, funds that allow you to trade gold like a stock, and reallocating that money to yield-bearing assets. Look at this divergence. The descending line tracks Western ETF outflows, yet the global price of gold climbs right through that sell-off. Even when prices dipped below $4,000 an ounce, the momentum absorbed the hit and kept climbing. This divergence shows that the variables Wall Street usually tracks, interest rates and currency strength, are being overridden by a new set of global priorities. To understand this disconnect, we have to look at where the capital is flowing. Western institutional money is moving out of traditional safe havens and chasing high-yield AI tech stocks. The buyers driving these $6,000 price targets are central banks. They are quietly executing a strategy to accumulate massive quantities of physical metal. Analysts at JP Morgan estimate that much of this buying goes entirely unreported to the IMF. By purchasing through over-the-counter markets, these institutions are masking the scale of their global demand. The primary architect of this stockpiling effort is the People's Bank of China. They have been systematically buying tons of gold every month to bolster their national reserves. The catalyst for this rush was geopolitical. When the U.S. and its allies froze Russian central bank assets following the invasion of Ukraine, it proved that U.S. dollars held offshore could be weaponized instantly. That triggered a rapid wave of de-dollarization. Non-Western nations realized that by holding their reserves in physical gold instead of foreign currency, they could sanction-proof their national wealth. A domestic gold vault cannot be frozen by a foreign government. For Eastern powers, gold has evolved into a tool of national security, a physical hedge against the risk of Western sanctions. This strategy is trickling down to the public. In Asian retail markets, citizens are mirroring the hoarding patterns of their central banks. Over a single quarter in 2026, Indian investment demand for gold spiked by 54%. That increase happened while prices were sitting at record highs, ignoring the usual rule that high prices suppress buyer demand. While buyers still purchase decorative jewelry, they are increasingly treating it as a deliberate macro hedge, a way to protect their wealth from the weakening purchasing power of local currencies. In China, market premiums are rising. Citizens are turning to the metal to physically shelter their wealth from domestic economic instability and a prolonged slump in the property market. This alignment of state-level stockpiling and massive retail hoarding creates a permanent, elevated price floor. It is a physical supply squeeze that traditional models were not built to predict. Today, gold acts as a measure of global trust. It tracks the fracturing of the financial system, moving independently of U.S. interest rates. Long-term physical hoarding by entire nations has neutralized the impact of short-term ETF flipping by Wall Street funds. The physical buyers are simply outmuscling the paper sellers. For individual investors, the practical realities of owning the metal still apply. Prices remain volatile. Physical bars require secure storage, and digital ETFs suffer tracking errors. But in an era of geopolitical fracturing and soaring national debts, the appeal of a tangible asset is clear. Physical gold has re-emerged as an uncancelable portfolio stabilizer.